Welcome to the SWIB Market Update. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB. Each quarter, we will talk with SWIB staff about the economy, the markets, and how the Wisconsin Retirement System trust funds are impacted. We'll also discuss how SWIB is working to help the WRS remain among the nation's most resilient pension funds, growing and protecting participants' benefits, and giving them peace of mind to focus on work, life, and the future. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find this show. Today, we welcome back SWIB head economist and asset and risk allocation chief investment officer, Todd Mattina. Todd, thanks for joining us.
Oh, well, thanks for having me, Chris. I always enjoy the conversation.
So Todd, as we are heading into the final weeks of 2025 and the stock market continues to perform very well, seems to be carried by tech stocks, what are your thoughts on how the markets have performed in 2025? And is this sustainable heading into 2026?
Well, the story of 2025 is a very strong stock market driven by very narrow leadership. The S&P 500 index of large market value stocks is up by about 16 to 17% this year. But roughly 2/3 of that gain has come from just a handful of mega cap tech names, as you were saying. The top 10 companies now make up almost 40% of the S&P 500's market value, compared with just about 12% a decade ago, highlighting some of the highest concentration rates we've seen in U.S. stocks in many, many years. I don't think, though, that this is a repeat of the late 90s bubble, because today's market leaders are actually generating real earnings and cash flows. But that said, some AI-related stocks are trading at 40 to 50 times expected earnings versus something like 25 times for the broader stock market and a long-term historical average that's closer to 17 to 18 times. So that's a lot of optimism priced in for technology and AI-themed stocks. A lot has to go right. But outside the tech sector, valuations are generally more reasonable, and many non-tech sectors could actually benefit in the coming years from greater AI adoption that improves their productivity and profit margins. So as we look forward to 2026, a broadening of the market rally to non-tech sectors could help sustain overall market gains. But high concentration and elevated valuations also raise the risk of downside volatility. For long-term investors like SWIB, what matters most isn't the next year. It's the expected returns in the next decade and even longer term. And historically, when markets start from an expensive valuation point, future long-term returns tend to come in below average. So in terms of the 2026 policy portfolio allocation, a lower target allocation to public equities would allow the core trust fund of the Wisconsin Retirement System to achieve its required long-term return of 6.8%, maintaining the plan's long-term financial stability, but with lower downside risk.
So this is why asset allocation and the fact the Wisconsin Retirement System is fully funded is so important, right? SWIB can diversify its holdings, doesn't have to swing for the fences to generate returns or try to time the market. We can be patient and kind of let things play out and not take unnecessary risk with the trust funds.
Right. You touched on some really important points there. Asset allocation is probably the most important decision we make in terms of its contribution to the overall system's return and its risk profile. When thinking about asset allocation for the WRS, we have to keep a very long-term horizon in mind. And that's in line with the long-term horizon of our liabilities, the pension benefits we pay all the beneficiaries and participants in the plan. So when we do think about asset allocation, it's critical for us to keep that long-term investment horizon in mind and be thinking not about the next year, not even the next 5 years, but the next 10, 30, and even longer years, just to ensure that we keep the plan financially stable and achieve that long-run required return that keeps the plan stable in terms of an appropriate rate of dividend increase for our beneficiaries, stable contribution rates, and fully funded.
The Federal Open Market Committee met this month. Heading into that meeting, some members argue that inflation remains too high, and they saw little justification for another rate cut at the time. Others, concerned by signs the labor market is weakening, believed a further cut was warranted to support employment and economic growth. Recent events, for example, the government shutdown, have delayed key data releases on employment and inflation, which added uncertainty to the decision and intensified the divide. Ultimately, they did decide to lower the rates. Were you surprised by the decision the committee made on interest rates?
Yeah, well, I think like most market participants, I wasn't particularly surprised by the Fed's quarter point cut this December. While inflation is still running above the 2% target, Fed policymakers have become more and more concerned recently about the softening labor market outlook, with the pace of payroll gains slowing. That creates a classic policy dilemma for the Fed. Inflation argues for holding interest rates steady or even raising them, while the labor market concerns argue for easing. On top of that, the Fed was operating, as you mentioned, with less economic data than usual because the government shutdown delayed key payroll and inflation releases. So, given that uncertainty, the December decision looked like a so called insurance rate cut. Now, markets had priced in about a 90% chance of a 25 basis point move by the Fed, and the Fed delivered exactly that. What was somewhat surprising, though, was the Fed's messaging. So their message was essentially one more rate cut next year as expected, and then we're in a wait and see mode unless the data turns. After all, the median of the Fed policymakers' economic projections showed inflation around 2.5% in 2026 and gradually grinding lower, the unemployment rate low and stable near 4.4%, and healthy economic growth at just over 2%. In other words, the median Fed policymaker is signaling a solid outlook supported by just one more rate cut next year, implying that they believe Fed policy today is now close to neutral, neither restrictive nor stimulating economic activity.
So you mentioned that this creates a classic policy dilemma, right? Inflation arguing for holding interest rates steady, the labor market arguing for easing. Is this something that the Fed deals with all the time, or when is the last time we've seen kind of this push-pull among the policymakers?
It's a great question. You know, policy conflicts for central banks are well understood, but they're actually relatively less frequent than the normal situation. And the reason this has come up is the post-2022 inflation spike that was really the result of, looking back, excessively loose monetary policy and loose fiscal policy with very large budget deficits. We're in a situation where we are starting with a high inflation rate, but moving into a point in the economic cycle where the labor market looks like it could be weakening from here. And that's the root of the policy conflict for the Fed. When was the last time we saw that? Well, we have to go back into economic history a little bit to find those episodes. It was really during those periods when we had rising or high inflation with a slowdown in economic activity. So periods like that would have been in the 70s and early 80s, a period in the 90s, and periods like that, relatively infrequent times to face this policy conflict. And it's always a difficult choice for central banks to manage that policy conflict.
So the other thing I think that's really interesting in watching the Federal Reserve Open Market Committee and this meeting is that the committee really has been unified in the past, with formal dissents being relatively rare. The committee has not had three or more dissents at a meeting since 2019, and it has happened just 9 times since 1990. In October, we saw 2 dissents, one for a deeper cut, another for no cut at all. This month, we saw 3 dissents. Given that there's some difference of opinion on the committee now, and Jerome Powell's tenure as Fed chair will end in May, and the messaging that the Fed is giving after this December meeting, what direction do you think the Fed takes in 2026?
So the 9-3 vote really highlighted how divided the Fed has become. And that split shows up clearly, as you said, in their outlook for 2026. However, the Fed overall is more hawkish than markets at the moment. The median projection of Fed policymakers who make interest rate decisions shows just one more rate cut next year, and then they're done. But underneath that median is a remarkably wide range of views. 7 policymakers don't see any cuts in 2026, 4 expect no more than one, and 3 even see the possibility of a rate hike next year. So that leaves the projected Fed funds rate for the end of 26 anywhere in a range between 2.1% to 3.9%, one of the widest ranges we've seen in Fed economic projections in many years. By contrast, markets were pricing in about 3 rate cuts by the end of 2026 before this December meeting. And even after the announcement, futures prices are still implying about 2 rate cuts. So markets and the Fed agreed on this month's move, but they still disagree on the path forward. So given that dispersion, my view is that the Fed would have to stay flexible. Inflation is still projected above target next year. Unemployment isn't rising, at least not materially. And that means the bar for aggressive easing from here, from an economic policy point of view, remains pretty high.
So, with the dissent on the board, does it help that all of the Federal Reserve regional bank presidents, with the exception of Atlanta Federal Reserve President Raphael Bostic, who recently announced he's retiring at the conclusion of his term in February, they've all been reappointed by the Federal Reserve Board of Governors? Does that continuity, even with the disagreement maybe in which direction to go, especially with Chairman Powell's term ending in May, does that help create some stability going into 2026?
I think there's 2 sides to this. So it does create continuity, which is important for any organization, and maybe especially for the Fed, given the importance of its mandate. But it also sets the stage for more internal conflict in the sense that some of the newer members who are joining the Fed have a different view than some of the previous members in terms of what's appropriate for the outlook. So this could set the stage for even more internal differences in point of view about the economic outlook. We did see in the economic projections, some of those regional Fed presidents who were not voting members for this December decision sort of quietly opposing the move by forecasting higher rates, even in 2025, sort of an implicit disagreement with the policy rate cut that we got in December. So I do think there's continuity in terms of the sort of expertise and knowledge and the inner workings of the Fed, but there could be more of these divided rate decisions going forward.
So, how important is the change in the chairman of the Federal Reserve going to be?
I think it could be quite significant. The Federal Open Market Committee, the FOMC, is a voting committee that decides on the next rate decision. But I mean, it's well understood that the chairperson of the Fed sets the tone. I mean, it's pretty unusual, and it might be unprecedented, where the chair's point of view was outvoted by the rest of the committee. So I do feel that whoever will be leading the Fed in 2026 and beyond will have a task ahead of them in terms of getting buy-in across all the different FOMC voters for their point of view. Because as we were mentioning, there's quite a wide dispersion in views from those who would like to see the rate increase to those who would like to see the rate significantly decreased. So I think it's going to be a pretty tough challenge for the new Fed chair to bring some cohesion and consensus to the Fed and their policy outlook.
And then one final question. Besides inflation and employment numbers, what are a few other things that maybe are on the radar for 2026 that could impact the markets and then the Federal Reserve's decisions on interest rates?
Sure, that's an interesting question. You know, the Fed and any central bank typically focuses on things like inflation, usually inflation foremost. And given the Fed and its dual mandate, it focuses on both inflation and the labor market, full employment, equally as objectives. But the Fed also has a broader mandate, and implicitly at least, to look at things like financial stability. So what is the situation with the major banks in the US? What is their risk profile looking like? If we see any more financial accidents or tightening in financial conditions, which is sort of Fed jargon for saying there's a drop in the stock market or interest rates increase sharply, or something that could suddenly affect both the health of banks as well as the economic outlook, I think that would also be an important consideration for the Fed to take into account. We've seen this recently when there's been pressure in short-term funding markets, for example. What happens is that there's a squeeze in liquidity where most financial agents out there from banks and other financial agents are scrambling for liquidity at the end of the year. So the Fed has been in a position where it needs to help provide that liquidity to prevent the interest rate jumping relative to the target that it wants to keep. So the Fed has been moving to try to make sure that its monetary policy is being implemented effectively by providing different vehicles to inject that liquidity into the financial system and keep sort of front-end, short-term money market rates under control. So I think to your question, there's a lot of other factors beyond employment and inflation, even though those are the two most important ones, that the Fed has to pay attention to.
Definitely will be an interesting 2026, that's for sure. Todd, as always, this has been very insightful. Thanks for taking some time to give us an update on the markets and the economy.
Thanks so much.
The SWIB Market Update is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media, branded podcast production for businesses, podcampmedia.com. Thanks again for listening. I'm Chris Preisler.